Hello, thank you for being here. I'm going to give a talk at the Money Show coming up in 10 days, so this is sort of a practice talk for me, and I just want to talk about trading on different time frames and how I use relative strength to help me in my training. So just to give you a little bit of a background, I grew up in Boston. I've been trading about 16 years now, mostly swing trading. I trade anywhere from a few days to a few weeks time frame. Sometimes shorter, sometimes a little bit longer, depending on the market. And I worked for a gentleman named Mark Minervini in New York here about 10 years ago or so. Worked for him for a couple of years. Mark is, I'm a loser. I carry this around and read it. But there's a series of books called Market Wizards. I recommend you guys read this. I have a recommended reading list at the end of the show. Market Wizards is a series of books by Jack Schwager. Interviews with some of the top traders on Wall Street, Paul Tudor Jones, Stephen Cohen, Druckenmiller, all these people. My old boss Mark was featured in the third one called Stock Market Wizards. So very lucky, very blessed to have learned from somebody who's a very, very sharp trader. So I wanted to pass along a couple of things that I learned working, just trading over the last 10, 15 years, and hopefully some of this will also help you guys with your trading. Just really quick, if I were to do a full seminar on, there's so many different topics. Trading 15, 16 years, you pick up so many different topics. You know, my philosophy overview, I can just tell you in general, I believe the market's healthy 2 to 3 times a year, and identify those healthy times, and that's, I mostly trade on the long side. That's where you're going to do, that's where I do well. And then obviously the stocks you want to pick, that's the number one problem I find with a lot of stock traders, is that their stock selection is very, very poor. So I'm not a big fan of trading big cap stocks. You'll never see me trading any Dow stocks or Cisco or Microsoft or Dell, because to me those are dead money. I'm looking for newer entrepreneurial small mid cap growth stocks. So again, I could spend an hour going through every one of these. Some of the screens that I do, I screen the market every night, 8 to 10 screens. I look at 1,000 stocks individually every single night, and I can go through all these, the signs of a healthy market. I get a lot of questions about position size, stop losses, how to find leading stocks. The reason I wanted to talk about relative strength is because I think it applies to everyone as far as time frame. Whether you day trade, whether you short-term trade or long-term trade, you can use relative strength to give you huge, huge advantages in your trading. Now, I want to quickly give a definition of relative strength. This is not an IBD, William O'Neill definition. It's not RSI. Relative strength is just pretty plain and simple. Relative to the market, stocks that are showing strength. That's all I'm looking for. When I'm looking at the market during corrections, during pullbacks, I'm just looking for relative to the market stocks that are holding up well, and I'll get into exactly what I'm talking about. Now, this is the first chart I want to show you, and this is going back to when I went to work for my old boss, Mark. He was featured in Barron's in October of '98, right about here, and he called for a market bottom, and he put 5 stocks in Barron's that he recommended over the weekend edition of Barron's. And I hadn't been working for him at the time, and I was following him, and all 5 stocks exploded. Every single one of them, 100, 200, 300% gains. When I went to work for him, I worked for him around 99, 2000, I said to him, I said, how did you pick those stocks in Barron's? I mean, it wasn't luck. You don't pick 5 stocks and every one of them double or do more than that. And he said something very interesting to me, because this was back in 1998. I'm going to give you a few examples up until as recently as the Egypt sell-off just at the end of January. So I'm going to show you how this pattern repeats itself over and over. And what he told me was, one of the stocks he picked was Yahoo. He told me that the market had a correction down and Yahoo had a correction. And he explained it to me as a spring, which is the stocks are like a spring that are ready to explode, except the tension of the market is keeping it down. So you can see we had a little bit of a recovery here, and then Yahoo went to new highs. This is the very important part here. When we had this leg down, this was Russian debt crisis, long-term capital blew up in September, October of '98. See how Yahoo just barely corrected, just held right there. This is what I mean by a spring. This thing's at a new low. The second the tension's relieved, I'll show you the next slide. This is right here, October of '98. The second the tension's relieved, Yahoo goes on to a huge gain over the next 15 months. Okay? Another example I'm going to show you, very, very similar pattern, was Broadcom back in 98. This is the same chart of the NASDAQ correction in 98. Same thing. As the market corrects, you can see relative to the market. This is what I'm talking about with relative strength. Relative to the market, this thing was holding up very, very well. And as you can see going on here, this was the exact same spot right here. So see, relative to the market, so the market's doing this, and this thing's just holding up like a champ. The second the tension is relieved off the market, the stocks that are going to new highs first, that are holding up very, very well, can go on to huge gains. And what I mean by trading on different time frames is that if you day trade, at least you know you have a high probability situation. If the market correction is not bringing this down, you can day trade this thing all the way up because you have a high probability. In other words, the market's not killing it. The second the tension's relieved, this thing's going to go. If you swing trade it, like I might trade it, let's say, in here for a couple of weeks, and then when it sets up again, I might trade it in here. Or if you're a longer-term holder and you buy this here and you want to hold it for 6 months, a year, or longer, you have a high probability that it's going to be a big winner. So that's what I mean by you can use relative strength to trade the trend, short-term, medium-term, or long-term. So these are a few points that I want to make, which I noticed from this philosophy, which is someone said, okay, you're going to show us how to pick, I told them I'm speaking at the Money Show, they said, you're going to show us how to pick winners using relative strength. What are the tools we got to use? And I said, you just got to pay attention. You got to pay attention. I'll give you a perfect example today. Market opens down, right? I have 30 or 40 stocks on my watch list. Every single stock, bloody red all over my screen. I'm sure with most of you guys too. One stock turned green. On my watch list of stocks, I trade a lot of growth momentum names. Open table. 30 or 40 names on my list. Open table is the first one to turn green this morning. Stock finished up close to $6. So that's what I mean by even on a short-term basis, you have a universe of stocks. When the market relieves that tension and starts to come back, that is a stock, again, relative to the market, showing strength. So the market's getting killed, and NASDAQ's down 25, and this thing's turning green. That's what I mean by using that on a short-term basis. So when someone says, well, what are the tools you use to pick these, I just say pay attention. Open your eyes. Pay attention to what's going on. Pay attention to the stocks on your list and what's holding up very, very well. The second thing is embrace corrections, because out of corrections, stocks build bases going back to, these are during market corrections. This is a stock that's building a base. In other words, when the market's healthy, as it was in most of '99, the stock's going up. When there's a correction, that's where bases come from. Stocks build bases and go sideways and consolidate during market corrections. So that's why I say embrace corrections, embrace pullbacks in the market, because that's where you're going to find big winners, because the market will give you these clues. The other thing is, I don't like to argue with the market, because a lot of times, people were short Yahoo back then, people were short some of these stocks, and sometimes when you have a general fundamental philosophy about stocks and the market's going the opposite, don't argue with the market. The market's always right. So that's a big fan. I'm a big fan of not arguing with the market and using relative strength to my advantage. And when I say sometimes things don't make sense, I'm going to get into it. This is another. I'm going to show you examples from '98 all the way up to present time. This is another example, Panera Bread. This is what I mean sometimes by the market doesn't make any sense. This is the internet bubble crash in 2000. The NASDAQ was at 5,000 here. In 15 days, the NASDAQ went to 3,100. So almost 2,000 points in 15 days in the internet crash, okay? And I'm sitting there and I'm noticing Panera Bread's making new highs every day. And I'm saying to my friend, I said, this is unbelievable. You heard about this Panera Bread? He said, oh, I'm short this stock. And I said, why? He said, oh, because the Atkins diet. I was like, that's the dumbest thing I've ever heard. And I was like, what's the Atkins diet? He's like, oh, it's great. I'm eating 19 cheeseburgers a day with no bun. This is great. I'm like, are you kidding me? And he's like, I just had another cheeseburger. So seriously, this is great. And he says, I'm short it. And I said, why? He says, because it has the name bread in it, and no one's going to eat bread. And I'm like, okay, I'm going to stop eating bread because of the Atkins diet. But the whole point is, I'm sitting there saying, sometimes these things don't make any sense to you. Like Yahoo didn't make sense to people at the time. Panera Bread, I mean, I'm sure people have heard of eating at a Panera Bread. The whole point is that this just IPO'd, and I'm using relative strength where the market just corrected 40%, and this thing's making new highs. This is exactly what I'm talking about. This was back then in April of 2000, where a lot of people were short the stock and continued to short it and doubted it, and now it's become a staple. That's the thing. A lot of times people short restaurants, retail that they think are fads, and sometimes like LA Gear was a huge winner, but it was a fad. Maybe Crocs might be a fad. But once in a while, you get restaurants like Panera Bread, or you get Coach. Coach was doubted when that IPO. Now Coach is a staple. So sometimes a lot of people like to short and doubt retail names, both retail restaurants and clothing, but they end up becoming very big winners. This is another example I'm showing you in 2001. This is September 11th, September 2001. Same thing. It just didn't make any sense to me. The market's closed for 4 days. It reopens that Monday. Everything on my screen, complete disaster. WFMI is Whole Foods. Whole Foods is making new highs. And again, I'm saying to myself, the world's coming to an end here, and why is organic chicken making new highs? This makes no sense to me at all. But that's what I mean. Sometimes it doesn't make sense because the market, if you study Jesse Livermore, I'm a big fan of studying success and studying old, great traders. Jesse Livermore says the market is meant to fool the majority. Okay, so again, the world's coming to an end here. Whole Foods is making new highs. Exact same thing. This is the big consolidation coming right out of September, fall of 2001. Whole Foods goes up to a huge, huge gain. So I'm trying to show you that this is the point where it's coming out of this base, and then this is basically where it's breaking out. And you got to remember, 2001, 2002 were nasty, nasty bear markets. So the fact that it's going higher during a bear market shows you that it could be a big winner. Again, you can trade this on a shorter term, medium or long term time frame. So I'm just